Hello and welcome to the session. Management Accounting LO3 analyze actual and standard costs to control and correct variances. Have you ever wondered how businesses keep track of their financial performance? Variance analysis is a crucial tool in management accounting. It helps organizations monitor costs and identify deviations from budgeted figures. Standard costing sets expected costs and revenues for materials, labor, and sales. It serves as a feedback mechanism, comparing standards with actual results. The main goal is cost control and performance management. Standards are set based on realistic assumptions. Variances are calculated to identify areas needing corrective action. Standard costs represent what costs should be under efficient conditions. Actual costs are what costs were incurred during the period. The difference between the two is called a variance. Favorable variances occur when actual performance is better than expected. Adverse variances indicate worse than expected performance. Sales price variance is calculated by actual price minus standard price multiplied by actual quantity. Sales volume variance involves actual quantity minus standard quantity multiplied by standard price. Material price variance is standard price minus actual price times actual quantity. Material usage variance considers standard quantity minus actual quantity times standard price. These calculations help identify cost discrepancies. Labor rate variance is standard rate minus actual rate times actual hours. Labor efficiency variance involves standard hours minus actual hours times standard rate. Overhead expenditure variance is budgeted overhead minus actual overhead. Overhead volume variance considers standard hours minus actual hours times standard overhead rate. These variances highlight inefficiencies in labor and overheads. Variance analysis compares actual performance against budgeted figures. It acts as an early warning system, highlighting problems quickly. By breaking down differences, managers can pinpoint responsibility and root causes. It is not just about identifying adverse outcomes. Favorable variances need review too. Integration into budget monitoring enhances effectiveness across the organization. Effective variance control relies on clear reporting systems. Management accounting reports are often supported by spreadsheet software. Key features include comparison of actual versus budget figures. Regular variance reports support informed decision-making. Reporting systems must focus on significant variances that affect performance. Corrective action follows variance analysis. Management can take steps like renegotiating contracts or revising staffing levels. Variance analysis links planning, monitoring, and corrective action. It improves financial discipline and organizational performance. When embedded properly, it supports continuous improvement. Northside Drinks Limited manufactures bottled juice. December's standard selling price was £70 per unit. Actual output was 3,200 units. Actual selling price was £69 per unit. Variance analysis revealed a total cost variance of £10,540 adverse. Material price variance was £1,320 adverse. Material usage variance was £1,200 adverse. Total materials variance was £2,520 adverse. Causes include supplier price increase and waste. This requires management investigation. Labor rate variance was £3,350 adverse. Labor efficiency variance was £3,600 adverse. Total labor variance was £6,950 adverse. Causes include overtime premiums and slower output. Management should address scheduling and training. Variable overhead spending variance was £670 adverse. Variable overhead efficiency variance was £1,200 adverse. Total variable overhead variance was £1,870 adverse. Fixed overhead expenditure variance was £1,200 adverse. Fixed overhead volume variance was £2,000 favorable. Variance analysis is crucial for budgetary control. It allows early detection of problems and supports managerial accountability. Variances provide evidence of performance against targets. They also improve future planning and budgeting by highlighting unrealistic standards. Effective variance analysis requires thoughtful interpretation. Variance analysis relies on the quality of budgets and standards. Poorly set budgets lead to misleading variances. There is a risk of short-term focus over long-term value. Despite limitations, variance analysis remains essential for budgetary control. It should be used alongside professional judgment. Identifying variances impacts control, monitoring, and improvement. Variance analysis influences behavior and decision-making. It strengthens financial discipline and supports timely corrective action. Regular variance reports allow trend tracking and benchmarking. However, excessive focus on variances can have negative effects. Management accounting techniques impact resource allocation and risk minimization. Marginal costing supports optimal short-term allocation. Activity-based costing improves longer-term allocation. Variance analysis identifies deviations early to minimize risk. Capital budgeting ensures long-term investments generate returns. Together, these techniques optimize performance. Profit maximization is supported through improved pricing and cost control. Cost-volume profit analysis aids in understanding profit impacts. Variance analysis ensures actual performance aligns with planned contribution. Profit maximization involves informed trade-offs between cost, quality, and volume. Management accounting techniques enable these trade-offs. In conclusion, analyzing actual and standard costs is a key aspect of effective cost control and performance management. By comparing actual costs against standard or budgeted costs, organizations can identify variances and understand the reasons behind them. This analysis enables managers to take corrective action, improve efficiency, and prevent future cost overruns. Analyzing cost variances supports better financial control, enhances operational performance, and helps organizations achieve their cost and profitability objectives. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 0748 436 1688.